Welcome back, everyone. In our last video, we talked about what CFDs are. Today, we're going to take it a step further and break down how CFDs actually work. By the end of this video, you'll have a clear understanding of the mechanics behind trading CFDs. So, let's get started. At its core, a CFD trade involves a few key steps. First, you decide on the asset you want to trade. This could be anything from stocks, indices, commodities, to cryptocurrencies. Next, you open a position based on your market outlook. If you think the price will rise, you'll go long or buy the CFD. If you think the price will fall, you'll go short or sell the CFD. Once your position is open, you'll monitor the market. The value of your CFD will fluctuate with the price of the underlying asset. Finally, you close the position. Your profit or loss is determined by the difference between the price when you opened the position and the price when you closed it. For example, let's say you buy a CFD on gold when it's priced at $1,800 per ounce. If the price rises to $1,850 per ounce and you close your position, you've made a profit of $50 per ounce, multiplied by the number of ounces in your contract. On the flip side, if the price drops to $1,750 per ounce, you'd incur a loss. One of the key features of CFDs is leverage. Leverage allows you to control a larger position with a relatively small amount of money, known as the margin. For example, if a broker offers 10-to-1 leverage, you could control a $10,000 position with just $1,000 in margin. However, while leverage can amplify your profits, it can also magnify your losses. Let's break this down with an example. Imagine you open a long CFD position on a stock with 10-to-1 leverage. The stock price increases by 2%. Without leverage, a 2% gain on your investment might seem modest, but with 10-to-1 leverage, your return is magnified to 20%. That's great when the market moves in your favor, but if the stock price drops by 2%, your loss is also magnified to 20%. This is why managing leverage and understanding its risks is crucial in CFD trading. When trading CFDs, it's important to be aware of the costs involved. First, there's the spread. The spread is the difference between the buy or ask and sell or bid price of the CFD. This is how brokers typically make money, and it's a cost you'll need to cover when you open a position. The tighter the spread, the less you'll need the market to move in your favor to start making a profit. Next, we have commissions. Some brokers charge a commission on CFD trades, especially when trading certain assets like shares. This is usually a small percentage of the trade size. Then, there's overnight financing. If you hold a CFD position overnight, you may incur financing costs. These are typically calculated based on the size of your position and the prevailing interest rate. It's something to keep in mind, especially for long-term trades. Finally, there's slippage and execution costs. There's the potential for slippage, when your order is filled at a different price than expected due to market conditions. This can happen in fast-moving markets, so it's important to be prepared. While CFDs offer great opportunities, they also come with risks. First, we have market risk. The value of your CFD depends on the price movement of the underlying asset. If the market moves against you, you could face substantial losses. Then there's leverage risk. As we discussed earlier, leverage can work both for and against you. It's crucial to use it wisely and not overextend your position. Next, we have counterparty risk. CFDs are contracts between you and your broker. This means your profits depend on the broker's ability to pay out. Always ensure you're trading with a reputable and regulated broker. I highly recommend using HFM. For more information, you can click on the link in the description. Lastly, there's liquidity risk. In some markets, it might be difficult to close your position at your desired price, particularly in times of low liquidity or high volatility. And that's how CFDs work. I hope this video has given you a clear understanding of the mechanics behind trading CFDs, including the benefits, costs, and risks. In our next video, we'll dive deeper into the concepts of leverage and margin. two critical aspects of CFD trading that you need to master. If you found this video helpful, don't forget to like, share, and subscribe for more content on trading. And as always, leave your questions and comments below. I'd love to hear your thoughts and help where I can. Thanks for watching, and I'll see you in the next video.